Hello and welcome to Property Matters. Today we're going to have a spotlight on the winter statement. I'm Stephen Galpin, and joining me today to explain it all to us is Zee Razaq, CEO of Surtax Accounting from St Albans. Welcome, Zee. Good to have you back again.
Looking forward, Stephen. I think this is going to be quite interesting for the viewers.
Okay.
All the info.
We'll keep it simple. We're not all as clever as you.
Oh, he's humbling me already.
Okay. Okay, Zee, what I just want to say as a bit of a preamble, I have a great sympathy for people in your profession. You take on a huge responsibility advising people. And we appear, I choose my words carefully, we appear to have a government at the moment that flip-flops from one policy to another, almost week by week or certainly month by month. And there certainly seems to be a lot of dissension in Parliament about who's supporting who. Must make that terribly difficult for you to give good, consistent advice, given the fact that you're advising on tax in a lot of cases and structures that are probably not going to actually have much of effect for 12 months' time. They're not going to be advised today and implemented tomorrow, are they?
Really good question to start off, Stephen. Get into the nuts and bolts of this.
Okay.
I think the biggest challenge, you're absolutely right, we have to keep updating our knowledge and skill set, understanding what is happening, what's the trajectory, what are they trying to achieve, how can we then advise our clients what they're incentivizing and what they're not incentivizing. So there's a huge, huge challenge. Definitely, I totally agree with you on that.
Okay. Well, I just wonder, as perhaps the starting point of our conversation, is we've obviously got to a point where I think all the pundits are suggesting that our economy is performing probably the worst in Europe, certainly towards the bottom in sort of geographical Europe. How on earth did we get here? The current government seemed to be just sort of saying, oh, well, that's the last government. No, it wasn't the last government. It's been the same government for the last 12 years, hasn't it?
You've hit the nail on the head, and this is such an important area that we do need to explain to the audience because it will make sense when we talk about solutions. If you look over the last, I would say 12 to 14 years, we had the financial crisis, the last one in 2008, and what happened after that was they started printing a lot of money, which call it technical term, quantity easing. If you suddenly don't have more goods and services and you print money, what happens is inflation, i.e. the price goes up. That's what we're feeling now of a policy that they've had for a number of years. And this is not good management of an economy. Right now they're having to find a solution by what they call QT, quantity tightening, i.e. taking the money back and getting rid of it.
The opposite of quantitative easing.
And this is going to have a big effect on property investors. So if we look from a property investors or developers, your property that had been going up because there's more cash about, now is going to have to go down if the money supply, i.e. the quantity tightening, gets reduced, and there's going to be less credit available. So less people are going to be able to access finance to purchase these properties. That's the big implication of number one. And I know that number two is going to be our fun area that we're going to talk about and spend a bit more time, is Brexit. And I don't think people really understand the impacts to our economy of Brexit. And if I look at the OBI, which is the Office of Budget Responsibility, an area very important, as we found out in the last few months, is that...
Well, certainly Miss Trust found out.
I love that. And Kamikaze Kwarteng as well. Even though I actually agree to some of these policies, that I think is the way he didn't get the OBR buy-in. And I think what's happened is, if we look at, without trying to get a political position, just a pure financial impact, what's happened is our gross domestic product, GDP, right, that's how we generate how much money the country is actually making, is going to reduce from 4 to 8%. If I put money onto that, that's £100 billion minimum. That's a lot of money when your total is about 2.5 trillion. So you're losing a substantial, and it could be higher. We don't actually know. So this has affected the economy financially, and it's restricted labour, which is, as we mentioned in previous conversations, that if you don't have the labour to support the property industry or any other industry to do the work, it falls over, and it also has a negative impact on entrepreneurs. So I think that's been a big issue. I don't know what yours is.
I mean, I look at these things in a very simplistic way, and I mean, it just occurs to me that probably Europe is our biggest neighbourly market. We've cut ourselves off from it. a lot of our, what shall I say, service industries are reliant on imported labour from Europe in the main, and we've cut ourselves off from that. But of course, it does bring a wry smile to your face when you realise that they're now talking about sort of going back into the market via some kind of Swiss model. But that will allow freedom of movement. It'll again put us back paying into Europe, and again suffering the European cause.
Absolutely. I think you're announcing what the CBI have been talking to the Prime Minister. There's such a big area at the moment. I think the biggest challenge with the Swiss-style agreement, and people haven't really looked into it, is we've got no influence because on the actual rules being made. Previously, we had influence and we had to follow all this. Now we're going to have to follow it without any influence. So we're actually in a worse position. And I don't know how people are understanding what the impacts are. I think the media has given different views on it, rightly so, but I think the overall majority and the dominant view, which is the most important, is economically it is not being good. And this is what's one of the biggest reasons where we've got the budget problems that we have. I think option number 3 is the bigger issue. Another issue is obviously COVID. That wasn't managed that well, so we spent a lot of money, probably when we didn't need to. That's caused impacts on debt. Our debt is probably at the highest level where we've seen in modern times, probably since the Second World War. That's going to cause problems. And then the fourth one, these are all affecting property investors and developers. Number 4 is the war in Ukraine. That's causing huge issues of running property businesses, because that war has led to cost of actually running a business, like the heating, gas, electric, your petrol to get from A to B.
And the production of building materials, the cost, the energy costs.
Absolutely, absolutely. So we've had 4 huge impacts that have led to what the current state of affairs are in the economy and the winter statement.
So what's the answer to that then?
Really, really good point. I think we're going to get into solutions a bit later. I think the bit that we've got to look at is how do we help resolve these issues. I think you touched on how they're trying to resolve Brexit, because most business owners are clearly stating to the government, these conditions are not allowing us to grow. And if you don't have the conditions available to grow your business, ultimately you go contract or you go back the other way. And that causes problems.
What do you think the political fear is here? Because I'm sure if you wheeled on the politicians one after another, they'd say, no. Well, in fact, they have done the last couple of days. Oh, Brexit's great. We're seeing great advantages from leaving the European Union. Yeah, what? Do you know?
I think the initial bit, the key reason where Brexit was sold, and it got through the media and certain political parties or MPs, was that immigration will be controlled. If immigration was the key driver of people's issues, and there is some merit, that we've got to be balanced, there is some merit on immigration, but ultimately, if you look at the history of the United Kingdom, we have been based on immigration. I'm sitting here with the great Stephen Galpin on Property TV because of immigration. And we've got to support that, but in a balanced point of view.
But again, you know, if you talk about immigration, it's a bit like talking about the property market. What do you mean? Do you mean commercial, residential, industrial? You know, what are you talking about? Immigration, what do you mean? Illegal immigration, genuine immigration, economic migration? What do they mean? I don't know.
I think they mix up these terms, and that's what causes the problem. If we look from an economic perspective, without getting political with people, economically you have the areas like cleaning, food picking and things like this, which obviously affect the economy. That's more the low skilled labour. We need some of that to keep on coming in. And people are just looking at the negative side, i.e. the cost of supporting that labour, but we need it, because it's like having the foundations of your house. If you don't put those foundations, the house tumbles. That's the first bit. Then,
well, hold on. I mean, when you say we need them, yes, we do. And the ones that come here and do that work, or used to under the EC rules, certainly didn't need any support. They were supporting themselves and they were paying tax, albeit at the lower rate perhaps, but they were paying tax. But now we seem to be suffering immigrants who are coming here, and because of the lack of system from our Home Office, are just in limbo for a year or 2 years doing nothing. And yes, they're requiring huge support. What is it, 6 million quid a day on hotels and things? So we're not quite getting it right, are we?
I think when you look at the cost of even asylum, which you were mentioning, which is a bit of a different aspect, even the cost of that in relation to us, and it's a bit of a political supporting wars, there's no comparison. So when we look at this, we've got to look at what the financial impact and is it the right thing to do? We've got to get that balance right. And I think people conflate this, and I think that's the biggest issue I found. I think we more need to look at the economies that are being affected by the economy, and that is the support infrastructure that we need in our economy to make it grow, and then look at the full value, not just the value of that individual, but that value in terms of the economy, because we've got to get certain jobs done.
Well, I agree. And I mean, if you go back 20 years, I mean, we used to almost make a joke of it, that if you wanted a plumber, electrician or tiler or a carpenter, chances are it'd be Polish. They've got a fantastic work ethic. Everyone that you called was probably Polish to come and do that work, and it was great. And then all of a sudden they sort of disappeared, and they disappeared because the economy in Poland suddenly became a lot better than it was here, and they could earn more money back home, and we lost that. So to my mind, we should have learned that lesson when we were applying the sort of visa restrictions on people coming from Europe, because it's affected the construction industry tremendously.
You've hit the nail on the head. One of your biggest costs is labour, right? And so I think the issue wasn't just financial for them, it was how we made them feel. When I speak to people from different backgrounds, they give me a bit of insight. If you make people feel not welcome from the stuff the media says and the politicians, which I'm not a big fan, because, you know, I've always believed Britain is about embracing. That's why we're here. You know, we've got an Asian Prime Minister, which I unheard of. And we've got a diversity as a key part of our economy to work together. And we should always embrace that. And sometimes, you know, you can't have a rule for every particular segment. You're going to have people that are not doing well and some of them that are. But as long as the majority is, and we think like that, we can then make it positive. And that's what Britain's always been, hasn't it?
It has indeed. Okay, well, on that note, we're going to go to the break now. After the break, we'll be asking Zee Razaq to comment on more of the government's policies keeping our country going. Hello and welcome back to part 2 of Property Matters. We're discussing today the government's new measures to get our economy on the right track, and we've got the benefit of Zee Razaq, CEO of Surtax Accounting, giving us his wisdom.
Thank you, Stephen. I think we were going to talk about the incentives of what the government had done, and this is the area where they've had a lot of criticism because the incentives are not there as they used to be. So we've got to look at probably what's there and what's probably going to get lost. One of the big incentives was, and something that was a brainchild of the current Prime Minister, the super deduction, which was a fantastic incentive to make property investors invest in their properties for commercial use, so they could claim back against their tax 130% tax credit. That means I'll spend 100 quid, I can claim £130 back against tax, which is fantastic.
And that's on plant and equipment, that sort of thing.
Absolutely, or refurbishments as well, right, in property. So it was a very important relief, and that was for limited companies only. And the challenge we got is that hasn't been extended. It wasn't even discussed. So 31st of March 2023 comes along, that's gone. So that's one less thing. The thing that, and I felt that was a big area missed. So the second part was the annual investment allowance, which is basically when I spend money, I get like up to £1 million per year. They have actually extended that for a number of years, and they haven't actually put a date when they're going to reduce that, because historically it was at a lower number. This is quite good, and I think as a country, once they get organisations and companies to take it forward, these are the kind of things they've got to start doing. And this is the approach a forward-thinking government should be having, is if you're going to tax people, you've got to incentivize them to then spend the money if you want to grow, because then they get reliefs. So if they don't do it, they get hit by the tax. If they do it, they get the incentives. But if you don't have no incentives and you have higher tax, what happens is the economy stagnates or what is actually happening right now. And I think that's been the big issue.
Okay. And have we seen anything in this winter statement that's going to be of real benefit to developers or investors?
I think one of the things was obviously the stamp duty aspect. That helps a little bit by increasing the band up, which was obviously pre-stated before this. They kept it. The challenge we've got is that they've actually put a date when they're going to stop having that. And that's going to be a bit of an interesting one when they stop doing that. And if you notice, a lot of the measures are not for now, they're over multiple years.
Yes.
And they've done it deliberately because of the election, general election, 2024 onwards, and that's what's going to happen.
Do people not see through this?
I think the tactics which Rishi and the current Chancellor, Jeremy, are using is, if I don't physically change the tax rates to individuals, they're feeling that the stealth taxes will help them, because that's what's happened. And when we go into it, the journey, and we can start on that, is that when you reduce personal allowances in real terms, it's a big issue. And if you think about what they've done, is they've frozen the personal allowance, which for anyone in the audience is 12,570 quid. It's only going to be rising in 7 years by £70.
Well, at today's inflation rates, I mean, you're losing 10% per annum, aren't you?
A minimum 5-10%. So when you do a scenario planning on that, and you do the financial modelling, that's huge. And people don't know. So it's bringing a lot more people into income tax. They've also froze the national insurance thresholds as well. So when you're actually looking at it, the actual cost to the individual is going to be a lot more. When you add then, that's for an individual person who bought property not in a company name, but when you bought it in a company, if we look at personal tax, when you extract the money out, dividend tax has gone up, and they haven't got rid of that national insurance element where they have for individuals. And I believe these are the things that are disincentivizing individuals. So when they go through the journey, what happens is, I buy property in my own name, I get hit stamp duty, and that's slightly beneficial with the changes, even though we've said they are going to reverse that post-election. Number two is the actual journey while I own the property in my own name. And this is what we were just talking about, personal allowance implications, which is quite big. And then the third bit is two parts. I sell it in my lifetime, which is the capital gains tax if it's a buy-to-let. The challenge is they've reduced the annual exemption. They've made it from 12,300, which have been frozen for a few years, and now it's going to drop to 6,000 from 23-24, i.e. April, and then it's going to drop down to 3,000, which is huge change. And this is why we're getting a lot of drive of people trying to sell.
Okay, you mentioned ownership there, so let's look at that. In the buy-to-let market in particular, we've had the government, I don't know whether discouraging is too strong a word, but certainly not encouraging smaller buy-to-let investments. The encouragement seems to be to push you towards limited company usage for ownership, and I'm guessing that that's partly due to the fact that it's easier to collect tax from a limited company. It's more visible, isn't it? It's more transparent, if you like. So let's just look at the two types of ownership and how that's been affected by the current regulations or the new regulations.
Absolutely, great question. So we explained how it's for people buying it in their own names, what impacts there are. I think one we missed was inheritance tax. That was my last one that I wanted to mention. That rate has been the same for 20 years. So that's back in 2009, and now they're going to do it to 2028. So in real terms, that's absolutely killing people, because 325,000 may sound a lot in certain parts of the UK, but majority of the UK, that's not much no more. That's your house. All right, and if you put your main house...
If you look around here, it's half a one-bedroom flat,
so,
isn't it? Yeah.
So typically you've got a husband and wife, partners, and they've got 325 each, and then 175 each for the main house. So say £1 million. That's not much when you look at the property prices and the trajectory of what's going on. So that's another problem on exit. Going to limited companies, the second part I was going to talk about, you've got obviously the stamp duty aspects are still effect when you buy a company, so that you still benefit slightly from that. But the bigger problem is, how do you take money out of the company? Because what they've done, as we discussed, is increase personal tax, both for your personal allowance by freezing it, which is a cost. I don't care what people say, it is a cost. It's huge. That's going to be thousands of pounds in the long term. And secondly, when you take money out from a dividend tax, and they've attacked dividend tax by two different perspectives. One is the tax-free allowance, which was in 2016, believe it or not, for the whole basic rate, you used to get a credit. Then it reduced to £5,000. And then good old Phil, spreadsheet Phil, they call it, he reduced it to 2,000, and now it's going to get reduced to 1,000 in 2023, down to 500, which is shocking.
Well, it's nothing, is it?
Yes. And the other bit is the actual tax rate, which we've mentioned earlier, has actually gone up and it will remain higher. For basic rates, it's up at 8.75. It used to be 7.5. So they've attacked it twice. And then obviously when you exit, the inheritance tax aspect on your shares becomes an issue, which we've just touched. So they've made it quite not advantageous as it used to be. And if you're an entrepreneur, you've got to have advantageous circumstances to make sure you take the risk to be an entrepreneur.
Do you know what? This is getting so complex these days, isn't it? I just wonder what your advice would be if somebody sort of naively wanders into your office and says, oh, see, I'm thinking of going into buy-to-let on my own. Do you think I should? I just wonder what your answer would be.
My first question to everybody is, how serious do you want to invest in property, if that is your strategy? And how long are you looking at investing? What is your long-term objectives? If you get the long-term objectives correct, you can then work backwards. And those conversations have to be had at the beginning, because if you don't know that, you're just guessing, and you have to sort of plan based on what you know now. So it could change, but generally there's certain areas that they haven't attacked historically, even though they have now recently. But if you think about it longer term, then you can come up with a strategy based on the current circumstances. You have to make the assumption, and then you can give them that value.
I think it's very important for somebody in that situation. It's very important to understand that today it's even more a business rather than some kind of secondary income that you're just going to add to your family's wealth. But the tax implications are very complicated. The structures need to be there, and I think again we see this time and time again at Property TV with people who write in with questions and ask us various things. You just need your experts, don't you? And without it, you're really.
I think the biggest area, which is, and I've said this previously as well, that is not looked at and is missed out, is the actual performance. Are your properties in your portfolio, either if you're developing them or you're investing in them, are they actually making the money? Have you got any metrics? Have you got a conversation with your advisor around that regularly? I think this is such a key area, and everyone's just like, oh, the government doesn't need it, so I just focus on the tax returns or the accounts. But it's like going for your car. Let's put it this way. When you go have your car, whatever nice car it is, right? You have the MOT, which is compulsory. But yet you do have a service because you don't have issues in the MOT. That's the same from when you're running your business. And talking about cars, big tip is electric cars, which are quite a big area, and they are changing under this budget as well. So if you are going to invest, probably a good time to invest in those.
Do you think so? I thought all the incentives were coming off.
No, so what's happening is currently it's 2% benefit in kind, which is like tax on having assets in a business that you use personally, which isn't that high. And from 2025 onwards, they're going to increase it by 1%. So it's still beneficial, because if you do it smartly and get the right advice, you can get the benefit without paying for all of it on day one. And that's still allowed for electric cars at the moment. They haven't got rid of that. The disadvantage is the old road tax, or what they call vehicle excise duty. You have to call it road tax. That's going to affect, but that's such a minimal cost.
Well, I think it's only fair if you use the road, you pay for it. I think
absolutely. And
I think at the risk of getting a load of bad mail, I think I'd like to see the cyclist paying for that. But anyway, we won't go on that. All right, Zee, listen, thank you very much, because I mean, I can tell you, listening to the government over these new policies, ideas, these mini budgets, these winter statements, my head spins with it. So I just have every sympathy with everybody trying to invest, trying to make a living. It's a very important factor, isn't it? We know you can't put residential properties into a pension fund, but there's no reason why a residential property can't be your pension, is there? And I think that's quite an important thing to mention. You've clarified everything wonderfully today. Thank you so much for that. So
Thank you.
Zee Razaq, CEO of Surtax Accounting, thank you for coming in. Thank you for watching. I'm Stephen Galpin. Join me next time on Property Matters.